I hope you guys are really enjoying your holiday today, and what I really wanted to talk about is we're now around 16 days into the new year. What are some of the best performing stocks in the year thus far? And that's what we're going to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. And let's start with some economic indicators first. So you can see that we recently got our inflation read, and now the annual inflation rate in the US slowed for the 6th straight month to 6.5% in December of 2022, and it's at the lowest level since October of 2021. And of course the decline was in line with market forecasts, but you know, this is a really nice thing to be seeing as we continue to raise interest rates. And so really what it tells us is that we can probably taper back the interest rate increases, and hopefully we get to a soft landing. I don't know if we get there, but you know, the Fed is trying to get the rate of inflation back down to their 2% target. And there's a lot of economists who believe that they will get to that 2% target by the end of this year. So Q4 of 2022 or Q1 of 2023, somewhere in that 6-month period. But it's not all sunshine and rainbows, because you can see here, this is the 10-year Treasury bill minus the 2-year Treasury bill. And so you can see that the yield curve remains inverted, suggesting that investors expect rates to decline in 2023 following an economic contraction. And so in other words, investors are forecasting that we're going to hit a recession in 2023, and the Fed is going to have to reverse course. So in other words, we'll probably hit that 2% or lower recession figure sooner, and so rates can be decreased sooner than that. So really what that speaks to is that the Fed has largely lost the confidence and credibility of investors. Now, I want to know what you guys think. Do we hit a recession in 2023, or do we hit sort of like a soft landing and the Fed doesn't have to reverse course so quickly? And it's interesting that the market still continues to rise. Now, on a year-over-year basis, the S&P 500 is still down. However, you can see that all throughout January, the market has just surged. And so it's kind of on that trajectory once again. And so we'll see if this is sustainable. And here's a list of the best performing stocks in 2023 thus far, at least. And I just have this 1 week price target increase amount. And so you can see that the United Airlines, Warner Brothers, and Amazon are three names that we're generally more interested in than the others that are up a lot. So you can see Warner Brothers is up 16%. Interesting to see Amazon surge back up, and of course the airlines, 20% over the last week. Now, what's interesting is one name that I thought for sure would be in the S&P 500 is Zillow. I think it is in the Russell 3000, but it's absolutely not in the S&P 500, which is kind of crazy because I think it's one of the more important companies in the economy. But, it's always the forgotten companies with strong moats that tend to do the best for value investors over time. And, you guys know that Zillow is a name that I've been talking about for a while. And so year to date, it is up 27%. And so this has done wonders for my portfolio over just the year-to-date term for 2023 thus far. And it's just that Zillow is continuing its rise from sort of like the late part of last year. So you can see that, it really dipped low in October, and then it's just kind of been surging ahead. So it was, close to that $27 per share. Now it's up at that $42 per share. So, that we were talking about it here. We were also talking about it earlier in the year as well, when it was more expensive. And so, it's nice to see this one come back. And largely the reason why this one's coming back is because, people are now starting to see what I was harping on for so long, and I just felt like nobody was paying attention, is that the housing market has a secular growth trend behind it. And over the next 5 to 10 years, the housing market will be just fine. And so in order to play this, you have to find the builders that will survive a recession. So in other words, make sure that they have strong balance sheets. Look for the builders that are nimble. Look for the ones that are building in locations that have strong demands, because not every builder is a national builder, right? Also, delineate between spec and tract builders. Obviously focus on the spec ones. And then, of course, when it comes to the technology names like a Zillow, they have a great balance sheet. They're going to survive the downturn. They will be back, especially if people are predicting that the interest rates are going to come down because the Fed is going to reverse course. Well, who do you think benefits in that environment? It's obviously home builders and, companies that support the home buying process, which is a company like Zillow. And so, I got into this when everything looked very dire. I got into all the housing stocks when everything looked very dire as well. And you know what? sometimes you have to buy before you hear the robins singing, because by the time you hear the robins singing, it's already spring. And that's a famous Warren Buffett quote. And this is how Barron's is describing it. This article came out just a couple of days ago, and so I saved it. And so, I've been the only YouTuber really speaking out the potential for housing market stocks to run. And in fact, every time I did talk about them, people kind of said that, I'm kind of dumb. I don't know what I'm talking about. And that's fine. There are situations where I am dumb and I don't know what I'm talking about. And so, I'm on record saying that the housing industry is a bigger position in my portfolio than even Chinese securities. And so now you have an analyst that just came out and said, that they're expressing their confidence in a housing market that could become more affordable, especially as interest rates decline, as everyone is already forecasting. So it's crazy that I'm kind of alone on this island right now. And here's what the Bank of America analyst said. He said, while real estate fundamentals remain very challenged given the macroeconomic environment and rates pressure, we believe the market may trough in early 2023 and are more confident that the market can return to double digits in 2024 on improving affordability. And so this guy is much more confident in the economy or the housing market than I am. That's for sure. If you look at the way that I'm forecasting these models out, I'm expecting a challenged 2023 and then sort of like a reverberating challenge in 2024. And the way that I think about this is, there's lead time that's required in order to build homes. And so, the stocks could recover, but these companies need time to sort of like sell these homes and, bring those orders in and, start organizing everything to build things. And yeah, I understand that the stocks will run prior to that, but the point I'm making is that, I'm not expecting a V. And so this Bank of America analyst is much more positive on this than I am now, which is kind of crazy because, nobody's been positive on housing as much as I've been for the last little while. So it's nice to see that I'm not the only one beating this drum right now. And so the question is, why do I love Zillow so much? And, the truth of the matter is that they maintain an extremely strong moat. Like, they have 3 times the number of daily searches than their nearest competitor. They have 63% of the daily app users of residential real estate searching. And so it is a leader by a wide margin, and that moat is not going away. You can have billions and billions and billions of dollars. You are not taking a substantial piece of the market that Zillow owns. This is very profitable. And the other thing that I love about Zillow is that they're defending their moat by constantly improving it. And so their revenue growths are aligned with what I'd like them to be doing, which is building out a super app. And so, you're not only able to have personalized search and finding capabilities, you can also look for rentals. You can do in-person touring, you can even do like online touring. And so that's really cool, where you can like walk through the house. I'm now starting to see metaverse optionality in this as well. And so that's really cool. You can, they have a partnership with iBuying companies like Open Door, and so that's really cool. And of course, you can settle payments as well. And so, there's a lot being developed here. The stuff that I'm most familiar with is obviously the searching, both the rental and the buying homes, and then of course the in-person touring. And I just love the way that the search capability works as well. I'm a big fan of the product, and I think it makes a huge difference if the company that you're investing in is a company that you are also a fan of. Peter Lynch talks about this all the time, where he would be looking at sort of different like products of companies that his family is interested in. There's a very interesting story of, I think it was like leggings that his wife really liked, and she was very interested in that product, and then I think he ended up buying that stock, and he made some money on that. And so you guys can correct me on that story. I read it like, I don't know, maybe like 20 years ago, and so you guys remind me. But the whole point that I'm making here is that it is wonderful if the company is something that you really enjoy the product or service of, and then you can also own the security of. I tend to do that a lot with my portfolio. Now, speaking of companies that I love the product of, Canada Goose is a name that I've talked about on this channel for a long time. And so year to date, or just in the last month or so, they're up 16%. And of course, year to date, if you just tracked it from December 28, of course, you can see that it's up much more. And, this is a name that I was talking about on this channel. It is also a name name that very few value investing YouTubers have been talking about, and largely because it's not really a name that's going to get you any views. But that's the uniqueness and the thing that I love about this channel. I'm constantly doing this research for myself. I'm constantly looking to add securities into my portfolio. And so, this was one that I even would, like, my wife and I would go for walks and I would talk to her about this one because she knows the product and she loves the product as well. And so it just seemed like an easy addition to the portfolio because it's a product we know, it's from Canada, it's being exported all over the world, and they make a very strong case as to why it's going to be used and sold all over the world as well. And so, it was an easy one to sort of get into. And, if you missed that video on Canada Goose, I will link it at the end of this one just to sort of explain sort of like how I thought about investing in this particular opportunity. And just sort of going into Canada Goose a little bit, so I don't even have to link the video. I just figured I'll just show it to you guys here, is that, they're having a fantastic 2023. They're going to be growing revenues, I think, at around 20%. That's kind of where I'm forecasting it. And then in 2024, I think it comes down a little bit, but not that much. And so I think growth continued at a breakneck speed in fiscal year 2023, which is coming to an end for them, and I'm forecasting it to come down. However, I still think this company remains exceptionally profitable. I still think that they grow internationally, and I still think that it's a brand that remains strong over the long term. And you can see this was my thesis on the name. They have 20% of their sales coming from Canada and another 28% coming from the US, and they have barely anything coming from the APAC region or the EMEA region. But you can see that in the total luxury spend of the world, Canada doesn't even register, as it shouldn't. We're way too small, right? We're smaller than some states even in the US. And so, you would expect a substantially greater amount of their sales to come from just the US and China. Canada should just be maybe like 3% to 5% of their overall sales. A lot of it should be coming from the US and China. And so, there's a huge runway for growth, and the way that they're addressing it is by doing direct to consumer expansion. They're also making partnerships with companies, et cetera, et cetera. And so they're going to continue to expand, and they have a huge runway to do it. But here's where the rubber hits the road with Canada Goose. Just using a 15 times earnings multiple, I just don't think that the valuation still supports hand over fist buying with this company. The opportunity was there, and it's kind of going away a little bit. However, because the company's still trading at a lower valuation relative to its intrinsic value, there could be some opening positions to be made here. Plus, I do think that the company will surprise on the upside relative to my valuation. And so, there is still money to be made here, but I'm not running at this hand over fist right now, but I'll continue looking at the cash secured puts to see if there's anything valuable there, and I can pick this up at a reasonable yield at least. Now, the other name that ran a lot over the last month or so was Crocs. Notice how it ran 34, almost 35%. And once again, this was another name where, like, I actually made a video about it, and then other YouTubers actually made the opposite video where they're just like, no, this is a crappy company, it's probably not going to do well, we don't like the acquisition, blah blah blah. And I'm not saying that they're wrong. They could ultimately be right, but the point that I was making was, like, I just didn't agree. I thought that this company was going to continue to do well. I like their geographic expansion capabilities, and luckily ended up doing somewhat well on the security. I think it's the best performing name in the portfolio this year, and I'm very grateful for that, especially considering the fact that this year a lot of people's portfolios were in the red, and luckily my portfolio was able to be very, very much in the green, and I'm very grateful for that. I don't get a big head about that. Just because it's ahead right now doesn't necessarily mean that I can't make mistakes in the future. And so, as you can imagine, the goal is to continue to focus on doing good research in the future and making good investment decisions, and making sure that I don't get a big head about it. Just do the right thing, make the right positions, and hopefully things work out at the end of the day. And that's the only thing you can hope for. I'm not going to pretend like I'm a Warren Buffett or anything. At the end of the day, half of it is just luck anyways. And so you might be wondering, why did Crocs surge so much? And really what's happening is that they're just doing well. They reported, or they're expecting to report, record revenues for fiscal year 2022. And a lot of the people just did not believe the growth story for Crocs. And here's what I did. You can see this is the Crocs model. And once again, you can get all my models at that lower tier of the Patreons. And so you can see here that although I'm expecting a 50% increase in revenue in 2022, notice how much I brought down revenue growth in 2023. I brought it down to 15%. It could absolutely go lower than that. The other thing that I did was look how far down I brought operating profit margins, right? And so you guys see me do this all the time. I just don't think this high profit margin in 2021 or this higher expected profit margin in 2022 is sustainable, especially in an environment where we go into a recession. So I think 2023 becomes painful. And just to be a little bit conservative, I just sort of forecasted it out at that painful amount. You could definitely bring the profit margins back up to 20% in 2025 and nobody would shame you for that. I'm just being pessimistic in my modeling, as I do with all companies, and it's fine, because what I'll do is I'll be pessimistic here, and then I will also be pessimistic on the price that I'm willing to pay despite the valuation that I get from being pessimistic. So it's almost like a double conservative type of valuation. So I really end up buying it at prices that, you know, the company really shouldn't be trading for, based on a reasonable valuation for the company. Now, some people would disagree and they say, look, just model it out the way that you actually expect it to grow and then buy it at 50% of its intrinsic value. And if you do that, I think you're more right than the way that I do it. But the reason why I do it the way that I do it is because I'm just worried about, you know, getting surprised on the downside. And so I try to factor in some of that. And then when the downside actually happens, I'm just like, hey, you know what? I kind of figured that was going to happen anyways. One area where that kind of saved me was my modeling of Alibaba initially. I think I was the only one that really slowed down China commerce. And, you know, when China commerce actually slowed down, that's when this channel kind of blew up a little bit. You know, it got to 5,000 subscribers from, you know, in the hundreds, is because I was the only one really saying, hey, you know, we expected this to happen, and it did happen. And so a lot of people started wanting to follow this channel just to sort of see how I'm modeling out the remainder of the years into, you know, the next 10 years or so for Alibaba. And so when it comes to the long-term guidance, you can see that for Crocs, they expect to hit $5 billion in revenue. And so they define long-term for Crocs. I'll just do the work for you here because, you know, they don't make it easy to see, but long-term for Crocs actually means 2026. For Hey Dude, that $1 billion of revenue actually means 2024. So by 2026, if Hey Dude continues to grow out, they're really expecting more than $6 billion of revenue. You know, you can add, call it another 300 grand, if that. And so you can probably expect 6.3 to 6.5 billion dollars of revenue by 2026. And just going back to my model, you can see that I forecasted out that $6 billion of revenue for 2026, but of course I took it on the operating profit margin. Now, some of you guys can say, hey, you know what, I don't want to forecast this out at the level at which they're forecasting revenue to grow, and you could absolutely be right, but you might want to bring up the operating profit margins as well. And so, you know, it's up to you how you want to do that. You know, there's no right or wrong answer here. And so where does the valuation sit? Well, you know, just using a 15 times earning multiple, which might also be a very low multiple for a company that's growing at the rate that it is. And I'm penalizing them for the debt that they took out for the Hey Dude acquisition, because I do expect them to pay that debt down. I'm valuing them at approximately $135 per share. Now, look where the current share price is. It's run up to $126 per share. So the share price as a percentage of its intrinsic value is pretty high. However, you know, it's still only trading at 12.4 times earnings, or an 8.1% annualized yield, or current yield. So, you know, there's an argument to say that this company is worth way more than, or is cheap at 12.4 times earnings, and or next year's earnings. And you know, you're probably right, but it just so happens that I've been a little bit pessimistic as it relates to my valuations. And really, what's happening here is that I'm expecting earnings to be higher in 2020 or in the next fiscal year than the fiscal year thereafter. And you can absolutely disagree on the way that I've modeled that out, but really the story there is that I think SG&A is running hot, and I don't think the low SG&A as a percentage of revenue is sustainable. I think that it'll continue to increase, and so I forecasted it to increase, which is what's bringing my operating profit margins down. Now, you guys let me know what you guys think on this story, but you know, the money is largely made here, and so I don't know if I'm going to hold on to my Crocs position for that much longer. It was a really good win for 2022 and 2023, but you know, this is a video about the best performing stocks. I don't really get excited about my securities doing well, especially exceptionally well. I mean, it's always nice to make money. However, I don't like to exit positions. So, you know, I'll think about this one and see how I feel about it in the next little bit. But, you know, I have purchased it at a low enough price that even if the share price comes down a little bit, I don't mind, because I do expect the company to surprise on the upside into the future. But I do see some troubling economics in the future because I think that their costs are going up. But we'll see how this plays out. Now, the last stock that I want to talk about that ran in 2023. Now, I don't know if I talked about this stock on the channel yet, but it's a company by the name of Boot Barn Holdings. We've definitely talked about this on our monthly calls. And so it's up almost 17%, which is pretty cool. And so for those of you who don't know what Boot Barn is they are effectively, they just sell sort of like boots and, cowboy type fashion accessories, like country kind of stuff. And so you can see that, clothing for the blue collar employment industry. I guess you got that country music lifestyle, and then hiking, hunting gear. I'll show you a picture of the store just to give you a better idea of what they sell. So here's a picture of a typical store. So, these standard boots, they almost look like Timberlands if you think about it, but just standard work boots. You can see the clothing. You got cowboy hats and jeans and, cowboy shoes and stuff. And, the first thing that I think of when I see this is like college kids doing cowboy night. And so they'd be going to a store like this to purchase all that gear, which probably is the reason why this company is so successful in a state like California. Obviously, they're successful in a state like Texas. You would expect that, but you would also expect them to be, somewhat universally popular in almost every state, just because, you have that, you have that like cowboy culture. Even in Canada, one of our biggest music festivals is a cowboy music festival. You wouldn't think that people from Toronto would fill up a huge music festival like that, but it does happen. And there is a huge culture of country music listeners in the country. And so this is their goal. They expect around 340 stores right now, and they expect to get to around 900 stores by 2031. And so they do have a path, a high level goal to get to 900 stores. Now, do I think that they get to 900 stores? Absolutely not. I'm going to show you how I'm modeling it out versus what they are forecasting out. But first, I just wanted to show you the stores that they're in, so you can see that they have a lot of stores in LA. Go figure, right? This is that whole thing I'm telling you about. Like, people like to pretend to be cowboys and go to like cowboy parties and stuff. So that's why, like, why else would you be selling? You have 15 stores in LA. Obviously, the 17 stores in Houston makes sense. Dallas, Fort Worth, I don't know, man. That's more of like a city, if anything. But, people in Dallas will disagree. They're like, oh, it's Texas, bro. It's like, come on, guys. Dallas and Fort Worth, like Dallas, Fort Worth is a big city, guys. You're probably closer to living the way that I do in Toronto than you guys are with people who are like more rural Texas, I would argue at least. But, I could be wrong. Las Vegas, 5 stores. They got 7 in Fresno, 7 in Sacramento, and another, like, these cities that, maybe Fresno, but not Sacramento. I don't see there being like a real cowboy culture there, but you can see that, the store resonates with people even in large cities. And, they're showing you the pictures of the cities right here, right? Oh, Fresno is a little bit more built up than I thought it was. Also, Nashville, I would expect a lot of stores in Nashville, and Nashville's right here with 6 stores. So I should have highlighted that, but you can see I've highlighted in red the cities that could sustain large amounts of stores as well. I think New York can definitely have maybe like 5 or 6 stores for sure. Probably the same amount as Los Angeles, so like 15 stores even. Miami for sure. Even in Tampa, I would say that you can probably have a store. Oh, look, they have 2 stores in Tampa. That makes sense. Cleveland for sure. Ohio, yeah, 100%. Big university town, so you can obviously have them. Boston, again, huge university town. You can definitely have stores. Washington, again. San Francisco, once again. See, I just think that there's a lot of room for growth for this company. So this is the model that I have on Boot Barn. So you can see that this is my forecasted number of stores that they will have at the end of 2023. And effectively what they're doing is to get to 900 stores by 2031, they're forecasting a 13% CAGR. And so, I don't think you can see by this 563 or 583, I don't think that they hit their 900 stores goal by 2031, but can they hit 600? I think it's a stretch goal, but I'm willing to forecast that out and buy this with a large margin of safety. So instead of their 13% growth rate, I'm going to give them a 8.7% growth rate. And let's see what that values this company out at. And so here's where I highly encourage you to take a look at that Patreon model that I have on Boot Barns, and just get access to the tracker. The tracker connects to all the models, including the Boot Barn model, the Zillow model, the Crocs model, and all the models that you just saw me talk about in this video. But I didn't give you the valuation for Zillow and I didn't give you the valuation for Boot Barn. I encourage you to go and check it out. And you know, really what it is that this Patreon tracker is available at just that $5 a month tier. And really what that is just essentially buying me a couple of coffees for getting access to all of my research. And so I'll leave it there for you guys. Now, if you missed that video on Canada Goose, you can actually get access to that video right here.